So, what if the secret to surviving a market crash isn't, predicting the future, but simply reacting blindly to the panic of today? Because usually, when we set up a classic stock bond portfolio, like your standard 60-40 or 50-50 split, there's this underlying assumption that market risk is just this constant hum in the background, like a thermostat set to a comfortable temperature. You pick your allocation, you set it, and you just forget it.
Right. Yeah. I mean, the entire foundation of passive investing is built on this exact idea of static risk. You just endure the bumps, but you trust the long-term average. You assume the market will eventually bail you out if you just, hold on tight enough.
But if you actually look at the last couple of decades, equity risk is absolutely not a constant hum. I mean, it is a violent roller coaster. Think about the VIX index,
Yeah.
which is what captures the market's expectation of near-term volatility. There is a time series chart in today's research spanning 24 years that shows this beautifully. You see these really long, calm, flat stretches where complacency sets in and the VIX just hovers down around 9 or 10.
Yeah, those quiet periods can last for years.
Exactly. And then, out of nowhere, those stretches are violently interrupted by these massive, dramatic spikes. You have this jagged peak piercing way above 80 during the 2008 financial crisis, and then another huge spike for the COVID-19 crash in March 2020, and a sort of sustained, jagged plateau during the 2022 rate hikes. So the median VIX over this whole time is about 17, but the distribution has this massive, long right tail of extreme, concentrated fear.
Exactly. The market doesn't really experience average risk. I mean, no one actually lives in the average. As an investor, you experience long periods of calm punctuated by moments of sheer, unadulterated panic. And when that panic hits, the correlations between asset classes completely break down, and that set it and forget it portfolio suddenly feels incredibly vulnerable.
Which brings us to the mission of today's deep dive. What if you didn't just sit there and take the beating? What if you mechanically reduced your stock allocation when the VIX is high and increased it when the VIX is low? Does scaling a stock bond portfolio using the inverse of the VIX index actually improve performance? And more importantly, does it hold up when you test it honestly, out of sample, with realistic transaction costs? So, okay, let's unpack this, because my immediate instinct is to throw up a massive wall of skepticism here.
Oh, totally understandable.
Right, because Wall Street is literally littered with these market timing schemes that look like absolute genius in a frictionless backtest. But the second you deploy them in the real world, the trading fees and the slippage just completely destroy the returns.
And you should absolutely be skeptical. That is exactly the right lens to bring to this analysis. But the research we are digging into today actually sets up incredibly rigorous parameters to test this exact challenge. We aren't just looking at theoretical, frictionless markets.
Okay, so what are the parameters then?
Well, the test runs from mid-2002 all the way to early 2026. That is nearly 24 years, covering roughly 6,000 trading days. So it's a very serious sample that includes two major crashes, a global pandemic, a brutal rate hiking cycle, and one of the longest bull markets in history. And they use actual traded instruments, the S&P 500 ETF, SPY, and the Intermediate Treasury ETF, IEF.
Okay, that makes it more realistic.
Exactly. Plus, it is strictly out of sample, meaning the rules are set based on past data, not future knowledge. And the equity weights are strictly capped between 0% and 100%, so there's no cheating with unrealistic leverage either.
All right, so to prove this isn't just whiteboard theory, we need to show exactly how the portfolio behaves when we tie its equity weight to the VIX. The framework here clearly lays out three benchmark portfolios. We've got a 40% stocks and 60% bonds split, a 50-50 split, and a 60-40 split. And against those benchmarks, they test two different scaling signals.
Yes. The first signal is simply the inverse of the VIX, just 1 divided by the VIX. The second is much more aggressive, which is the inverse of the VIX squared. And the scaling constant is mathematically calibrated so the average equity weight hits the exact same target as the benchmark.
Okay, let me make sure I have that right. So a 50% target managed portfolio holds 50% equity on average, just like the benchmark, but its actual weight moves around dynamically.
You've got it. That's exactly right. And crucially, the signal is always lagged by 1 day. So you are strictly using yesterday's closing VIX to determine today's allocation. There is absolutely no looking into the future.
And when you map this out visually, the contrast is incredibly dramatic. There is a chart showing how the equity weight moves over time for the 50% target portfolio. Normally, a 50-50 portfolio is just a boring, flat line right at 50%. But this managed line is it's chaotic in the best way.
It really is wild to look at.
Yeah, you see the equity weight plunge all the way down to near zero during the darkest, most terrifying days of the 2008 financial crisis. It is essentially fleeing the burning building.
Yeah.
And then during the calm bull markets, it confidently pushes all the way up toward that 100% cap.
And you really have to look closely at how the two different signals behave there. The squared version, the 1 over VIX squared, it swings so much more violently than the simple 1 over VIX signal.
Right, and there's a density plot in the research showing the distribution of these weights that really drives this home. The 1 over VIX signal produces this smooth, normal-looking distribution centered right around 50%. It's balanced, it sort of breathes with the market. But the 1 over VIX squared signal is entirely bimodal. Because it's squared, it bunches up heavily near the extreme edges.
Yeah, it basically forces an all-or-nothing approach. It essentially demands the portfolio to be fully invested or entirely in cash with very little middle ground.
It's like the 1 over VIX signal is a smooth defensive driver. They see brake lights a mile ahead, and they gently ease off the gas. But the 1 over VIX squared signal is like a panicked driver who only knows how to slam the pedal to the floor or just slam on the brakes.
That is a perfect analogy. The squared signal operates in pure extremes, and now that we understand exactly how radically this defensive driving shifts the portfolio, we really have to look at the scoreboard. Did all this shifting around actually pay off for the investor?
So here is the catch that I think a lot of people miss with risk parity or volatility targeting strategies. If you look at the cumulative wealth chart, the one showing the growth of a single dollar invested from 2002 to 2026, the constant 50-50 benchmark line actually finishes on top. It grows the most in total.
Which is counterintuitive to what most people want from an active strategy.
Exactly. The managed portfolios actually end up with less total money at the end of the 24 years. But their paths to get there are visibly smoother. It's like looking at the exact same mountain range, but the deepest, most terrifying valleys have been filled in with dirt. We aren't doing this to get richer. We're doing this to smooth out the ride.
Exactly. You have to clearly deliver that twist. The managed portfolios earn lower absolute returns, but they do it with significantly lower volatility. Let's look at the actual numbers for the 50% target. The static benchmark gets a 7.1% annualized return with a 9.0% volatility.
Okay, so 7.1 return, 9.0 risk.
Right. But the 1 over VIX managed portfolio gets a lower return, 6.4%. But the volatility plunges all the way down to 6.9%. So you are giving up about 70 basis points of return, but you are shedding 200 basis points of volatility.
Oh, wow. That's a massive risk reduction.
It is, and because of that massive drop in risk, your Sharpe ratio, which measures how much return you are getting per unit of risk, it jumps from 0.79 to 0.94.
And that smoothness is incredibly obvious when you track the historical drawdowns. Visually, you see the static benchmark dropping into a terrifying 27% hole during the financial crisis. But the managed portfolios look noticeably shallower. They cap the bleeding at about 21%. You still lose money, obviously, but you avoid that absolute bottom-of-the-barrel panic phase where investors capitulate and just make terrible decisions.
What's fascinating here is that this fundamentally reorients how we have to think about this strategy. This is a risk reduction story, full stop. It is not a return enhancement story. If you are a 25-year-old investor trying to maximize your terminal wealth over 4 decades, you probably shouldn't use this.
Right, because you need to capture every ounce of those long-term equity returns.
Exactly. But if you are a retiree, or a highly risk-averse investor who panics when they look at their brokerage app, someone with a risk aversion gamma of 4 or higher, you get massive utility from this. You are paying a small known premium in lost returns for the ability to actually sleep soundly at night.
Okay, so if adjusting for risk works, human nature naturally says we should push the button even harder, right? Like, if inverse VIX is good, the more aggressive inverse VIX squared or panic driver should logically be great. But the findings show the simple 1 over VIX beats the highly aggressive 1 over VIX squared across the board.
It does, and there are 2 main culprits destroying the squared signal here. One is turnover, and the other is mean reversion. Let's tackle turnover first. The squared signal trades roughly 10 times a year, compared to just 6 times for the simple linear signal. Every single time you trade, you pay a toll. You pay bid-ask spreads, you suffer slippage, you just bleed capital. But the second culprit, mean reversion, is even more dangerous.
Right, let's really explore why mean reversion is the enemy of extreme bets here. Because that panic driver is always slamming on the brakes, they end up fully out of market at the worst possible time. Think about how markets actually recover. The VIX spikes to 80 during peak panic like we saw in March 2020. The squared signal aggressively dumps almost all equities and flees to cash.
Which feels great in the moment.
Right, exactly. But what happens next? The Federal Reserve steps in, the immediate panic subsides, and the VIX starts to drop. The stock market rips upward in a massive violent relief rally. Because the squared signal was completely out of the market at the absolute bottom, it misses the initial explosive bounce. By the time the VIX is low enough for the squared signal to buy back in, the stocks are already 20% more expensive. Extreme positioning gets caught completely wrong-footed when the market snaps back.
That dynamic is exactly why the squared strategy bleeds out over time. And when you factor in the real-world trading costs, it gets even uglier. There's visual plotting how the Sharpe ratio survives as trading costs increase. On the left side, representing zero trading costs, all the strategies are bunched together looking great.
Okay, but what happens when you move to the right?
Well, as you track to the right, simulating higher and higher transaction costs, the lines fan out dramatically. The 1 over VIX squared line plunges aggressively downwards. At just 10 basis points of cost, it drops completely below the do-nothing benchmark. It actually becomes worse than just holding a static portfolio. Meanwhile, the simple 1 over VIX line declines gently, staying comfortably above the benchmark even as costs rise.
See, here's where it gets really interesting. Wall Street absolutely loves complex, aggressive math. They love engineering and selling the highly complex squared version of things because it sounds incredibly sophisticated in a pitch meeting. But reality, and specifically the friction of trading fees and mean reversion, ruthlessly punishes that complexity.
It's the classic story of a beautiful, theoretically perfect model getting mugged in the alleyway by reality.
Which brings us to a massive practical problem. If trading costs are the primary enemy of this strategy, how on earth do you implement it without bleeding all your money to your broker?
Well, you test every possible variation. There's a heat map that lays out every single combination we tested, signal type, rebalancing frequency, target weight, and it colors each cell by its Sharpe ratio. And the stunning takeaway here is the visual uniformity across the board.
What do you mean by uniformity?
That the colors look exactly the same whether you look at the daily, weekly, or monthly rows.
Wait, let me make sure I'm hearing this right. Doing this once a month is mathematically just as good as adjusting it every single day.
Gross of fees, yes. They give you the exact same risk-adjusted benefit. But think about the friction. The daily strategy forces you to turn over your portfolio 6 times a year. The monthly strategy requires you to turn it over less than once a year. It's a fraction of the real-world cost for the exact same protective benefit.
And it gets even simpler than that. The researchers looked at whether specific days mattered. Like, if you map out the day-of-the-week effects and the day-of-the-month effects in these simple bar charts, visually, the results are completely flat. All the bars are exactly the same height. Monday isn't special. Friday afternoon isn't special. The first business day of the month has absolutely no magic attached to it.
Right, there is no hidden calendar anomaly to exploit here.
So what does this all mean? To me, it feels like a total celebration of the death of financial folklore. There is no secret timing magic. You don't need supercomputer algorithms trading at 3:59 p.m. on a Friday to protect your downside. You can literally just rebalance your portfolio once a month on any random Tuesday, and the risk reduction math works perfectly.
It is remarkably robust, but as rigorous researchers, we have to do an honesty check here. Everything we've discussed up to this point is a backtest. And as anyone in finance knows, it is incredibly easy to look like a genius in hindsight. You just torture the data until it confesses.
Right, the classic data mining trap.
Exactly. Could this all just be a data mined illusion? To answer that definitively, the researchers split the data. They trained the model on data up to 2016 and then locked the rules. They literally threw away the key. Then they tested it strictly out of sample from 2016 to 2026.
And there's a scatter plot visual for this, comparing the backtest promises against the real-world out-of-sample delivery. Like, if a strategy performed exactly as well out of sample as it did in the backtest, the dots would sit right on this perfect 45-degree dashed diagonal line. But instead, we see this cloud of dots hovering just below that line.
Yeah, that's what we call shrinkage.
Right, so there is some shrinkage from reality.
Yeah.
The backtest promised a little more juice than reality actually delivered. But critically, the cloud of dots still floats comfortably in positive territory, performing well above the static benchmark.
And that shrinkage is completely normal. I mean, in quantitative finance, if your out-of-sample test perfectly matches your in-sample backtest, you probably made a coding error. What matters is survival. And there's further proof when they use a walk-forward expanding window re-estimating the rules every year as new data comes in.
Which is exactly how you would practically trade it in real life, right?
Exactly. And the walk-forward bar chart shows a 0.16 Sharpe point gain for the 1 over VIX 50% target. It shows a persistent positive gain for the simple strategy.
Right. And if you look at the rolling 12-month return difference line, it's this squiggly line that wiggles around zero. Sometimes it drops into the negative, meaning the benchmark is winning, which usually happens during rip-roaring, uninterrupted bull markets where risk management is just a drag, but it mostly stays stubbornly positive over the full cycle.
And this raises an important question about how we evaluate financial research as a whole. The modest nature of this gain is actually the strongest proof of its validity. If this backtest promised miracles, if it said you'd double your money and completely eliminate drawdowns, it would be an obvious lie.
No, for sure.
But a modest, persistent advantage that wiggles around but mostly stays positive across all specifications, that proves it's a real structural phenomenon embedded in market psychology, not just a data-mined fluke.
Okay, so we've spent this whole time proving that the VIX is a great predictor of risk. It reliably tells us when to play defense. But wait, can the VIX also predict future returns? Because if you can predict both risk and return, that changes the whole game.
It is the absolute holy grail of quantitative investing. And the logic seems sound, right? If extreme fear predicts a massive bounce back, we should technically be leveraging up and buying heavily when the VIX is highest.
So the researchers ran the numbers to see if today's fear predicts tomorrow's returns. If you picture the T-statistic bar chart for predictive regressions as a series of steps, at the 1-day and 1-week horizons, there's almost nothing there. The steps are tiny and flat. But as you look further out into the future, moving to the right, the steps grow steadily higher, reaching this really tall bar at the 12-month horizon.
And that tells us something vital. Today's VIX tells you almost nothing about tomorrow's stock return, but it does tell you something about the return over the next year. High fear today means higher expected returns over the next 12 months.
Why is that?
Because investors are terrified, and they demand significantly more mathematical compensation to hold equities during a panic.
And you can see that clearly when they use this quintile step chart to bucket the data from the calmest periods to the absolute highest fear periods. The calmest periods, which is quintile 1, yield about a 7% annualized forward return. The highest fear periods in quintile 5, when it feels like the world is ending, yield an incredible 19% annualized forward return.
I know, it sounds absolutely amazing until you look at the caveat.
Right, there's always a caveat. There is a scatter plot visual plotting the actual VIX index against the 1-month forward returns. And it is not a clean, predictable line. It is a dense, chaotic, shotgun blast cloud of data points. There is only a faintly positive trend barely cutting through the noise.
Yeah, it's very messy.
To put it in plain English, the R-squared, which is a statistical measure telling you how much of the return is actually explained by the VIX, is a tiny, microscopic 0.4%.
Which means 99.6% of the stock market's return next month is driven by things entirely unrelated to today's VIX. So the VIX predicts volatility brilliantly, but it predicts returns very poorly.
But this leads us to the absolute intellectual climax of this deep dive. Because the desire to predict both risk and return at the exact same time is not a new idea. This goes all the way back to the foundations of modern finance.
It does. It goes back to 1969. Robert Merton, the legendary Nobel laureate, derived the mathematically optimal portfolio formula. The math is elegant. It basically says your expected return sits on the top of the fraction, and you divide that by your risk aversion multiplied by the variance of the market on the bottom.
Okay, expected return on top, risk aversion, and market variance on the bottom. Simple enough.
Now, imagine you are a practitioner. You assume that expected returns are just constant, that they never really change. So you hold the top of the fraction steady. And then you decide to use the VIX² as your real-world measure of market variance for the bottom of the fraction. If you plug those two assumptions into Merton's Nobel Prize-winning formula, what do you get?
Wait, hold on. If I hold the top constant and use VIX² on the bottom, the optimal portfolio literally is the 1 over VIX² rule we've been talking about.
Exactly. The 1 over VIX² signal isn't just some random aggressive math the researchers made up to test. It is the implementable, real-world version of Merton's theoretically perfect optimal portfolio.
That is wild. But earlier, we just proved beyond a shadow of a doubt that the simple 1 over VIX rule completely crushed the squared version in the real world. How can the simple heuristic beat a Nobel Prize-winning optimal mathematical formula?
To figure that out, the researchers set up a horse race. There is a bar chart showing the four strategies standing side by side. They built the full Merton portfolio, which relaxes that constant return assumption. Instead, it uses the VIX to try to actively predict the future return for the top of the fraction while still using VIX² for the variance on the bottom. So it's trying to predict both sides of the equation simultaneously.
And when you look at the results of this horse race chart, it is incredibly revealing. The static benchmark sits flat at the bottom, and the managed strategies, the simple one over VIX, the constant return Merton, and the full Merton, they're all clustered close together at the top. The full Merton, where you predict both return and risk, barely edges out the naive one over VIX². It gets a 0.90 Sharpe ratio compared to 0.89.
But here's the crucial part.
Right. It still loses to the completely simple one over VIX linear rule, which sits safely at the very top with 0.94.
And that right there is the ultimate lesson of quantitative investing. Theory assumes you have a perfect, unclouded crystal ball for expected returns, and it assumes trading in the market is completely free. The Merton formula strictly demands the squared VIX to calculate variance, which, as we establish, triggers massive portfolio turnover and gets slaughtered by mean reversion.
Yeah, in the real world, our crystal ball for returns is incredibly foggy. I mean, remember that tiny 0.4% predictive power in trading costs real money? It is amazing. The Nobel Prize theoretical ideal gets beaten by a simpler, slightly dumber heuristic. Because reality, with all its friction and chaos, it just demands simplicity over precision.
So, to distill this entire deep dive crisply for you, VIX scaling genuinely works, but you have to use the simple one over VIX rule, not the aggressive squared version. You should rebalance monthly, not daily, to save on fees and slippage. And most importantly, you have to expect less volatility, not more money. It's a risk reduction tool designed specifically for the risk-averse, not a magic wand for return maximizers.
And that brings us to one final, slightly provocative thought. During that horse race we just talked about, the researchers tested a combined signal. It took the predicted return and divided it just by the simple VIX, completely ditching the squared VIX that Merton demands. Because the predicted return occasionally dipped into negative territory, this portfolio naturally went flat. It just stepped completely aside into cash whenever the math looked terrible.
And it achieved a fantastic Sharpe ratio with even lower turnover than our winner today.
Exactly. It makes you wonder, if you took a standard, highly complex, risk parity portfolio and just added a simple, rules-based, step-aside mechanism, could that be the actual real-world holy grail of quantitative investing? Just something for you to mull over.
It's a very compelling question to leave off on. In finance, sometimes knowing when to simply walk away is your most powerful advantage.
Remember, you can find the full research note, all of the R code to run this yourself, and the presentation deck linked right down in the description. We've talked about taming the roller coaster today, but the market never stops building new tracks. Thanks for joining us on this deep dive.